Today we will be going through our investment recommendations portfolio. We will be looking at the recommended investment options, then analysing each option. We will then review the efficient market hypothesis and look at how it can impact investment decisions, and then finish with a conclusion.
So on this slide is our investment recommendations for our clients £100,000. We divided the money across 4 categories in order to balance the risk and increase the chances of our clients making a return. So firstly, we suggested investing 40% of the money into stocks because although their value will fluctuate, it will grow steadily in the long term. Next, we suggested investing 30% into bonds. These are stable and low risk options in the long term, and our client will receive interest payment from the bonds, which provides them with a reliable source of income. The only downside to which is that they'll have to pay income tax on any returns that they make. We recommended putting 20% of the money into an ISA because this is a good way for our clients to save because they won't pay any income tax or capital gains tax. And finally, we advised keeping 10% of the original £100,000, so keeping £10,000 as liquid cash as a reserve, just in case our clients find themselves in an emergency or discover a new investment opportunity.
So firstly, we would like to recommend investing 40% of your funds into stocks. Stocks allows you to have the partial ownership of a company. There are 2 ways you can invest in stocks. Either by stock appreciation, this is when the stock price increases and you can sell your shares at a higher price, or through dividends when the company gives you a portion of their earnings. Stocks are high risk, high return. However, over an extended period, for example 5 years, the value of most shares naturally increases, meaning the risk is now moderate. We would like to recommend a diversified stock portfolio to reduce risk and minimise losses. Below states that the risk is high, there is possibility of high returns. The liquidity stocks can be low unless there is lots of interest from various markets, making the stocks very liquid. There is possibility of growth. And lastly, there is a 0.5% tax on the transaction when you buy shares, so you may need to pay capital gains tax if wanting to sell your shares.
We recommended investing 30% or £30,000 of our clients' original money into bonds. Bonds come in 2 types, government bonds and corporate bonds, and investing in these means our client will receive interest payments and even receive a profit on their original investment if they decide to sell the bonds on in the future. Bonds are moderate risk options with unpredictable returns, but they can provide high returns with regular interest payments, and the potential for the value of bonds to grow increases over time.
For the next investment option, we would like to recommend putting 20% of your funds into a cash individual savings account. By putting a percentage of the money into an ISA, it will provide our client with tax-free dividends, making this a low-risk investment options. We would like to suggest a cash ISA rather than a shares ISA, as they carry less risk. Alternatively, a savings account with a high interest rate will also be a low-risk but low-return option for our client. I'll now talk through the risk, return, liquidity, growth and tax implications. So the risk is low, but the value of an ISA can go up or down over time. The ISA offers a fixed or variable interest rate and has a predictable return. ISAs have high liquidity and you are able to access your cash instantly. For growth, ISAs have a good return rate. And lastly, for tax implications, any interest earned within the ISA is exempt from the UK income tax.
We recommend our clients keep 10% of their original £100,000 in cash as a reserve. This gives our client immediate access to liquid funds for any new investment opportunities or emergencies that might crop up. Keeping cash will give our client extra financial security, but the value of cash can be reduced over time due to factors like inflation. Therefore, this investment strategy shouldn't be used on its own and should only be used alongside other investment recommendations.
So now, looking at the efficient market hypothesis. This is a theory created by Eugene Fama, which states that the price of an asset reflects an array of data and information about that asset. This fact makes it extremely hard to consistently earn higher returns than the stock market. This is known as beat the market. The three forms of efficient market hypothesis is weak form, which means the share price reflects all past information; semi-strong form, which means that the share price of all past and current information is publicly available; and strong form, the price reflects all past, current and private unreleased information.
The efficient market hypothesis, or the EMH, states that the price of an asset tells investors lots of information about that asset. This means that while beating the market is unlikely to happen, certain investments can still achieve similar returns to the rest of the market, called average returns. An example of this is an ISA. ISAs are low risk but provide investors with decent returns because of market efficiency. Gilts and bonds provide reliable returns with moderate risk too. Stock prices are likely to fluctuate, but usually they will rise consistently over time. By keeping hold of stocks throughout the peaks and troughs, our clients will almost definitely reap some of the long-term rewards that the efficient market hypothesis states they will.
So, to conclude, the balance between investing in stocks, bonds, cash ISA and keeping cash reserve creates a range of investments that manage risk, provide growth and ensure liquidity for either short-term or long-term investments, as well as aligning with the efficient market hypothesis and focusing on realistic and achievable average market returns, which can lead to successful investments. Thank you for listening, and this is our list of references. Thank you.